Okay, so question 3 of 2023's 2.4 accounting exam. So we'll get onto that one now. So this one question here, sorry. So this question here is looking at equity in businesses. So we've got the equity ratio and the return on average equity. So equity ratio in 2022 was 0.67 to 1, increased to 0.71 to 1, 2023. And the return on average equity was 44.6% in 2022, increasing up to 52.4% in 2023. So, if we're just looking again, just wanting to answer the bullet points, if we're just looking to answer the bullet points, we'll get on to the first one, which is the meaning of the 2023 equity ratio of 0.71 to 1. So the equity ratio is looking at how much of the business assets were funded by the owner's equity as opposed to debt. So 0.71 to 1 means that for every $1 of assets that the business currently owns, 71 cents were funded by the owner, who is Mika in this case. When we're talking about equity ratios, ideally we want them to be between 0.6 to 0.85 to 1. Does depend on the industry, but if it falls below 0.5, could indicate a bit of instability in the business. And if it's too high, it could indicate that the business is not correctly utilizing debt financing. It might not be expanding or producing at the levels that it could be capable of if it was. And then obviously we've got Mika's music world here, which is really in that nice sweet zone of 0.6 to 0.85 to 1. So looking at this question here, we'll just say, so Mika's music world's equity ratio of 0.71 to 1 tells us that for every $1 of assets currently owned by Mika's Music World, 0.71 were funded by the owner Mika. Only 29 cents were funded by debt. This shows Mika would be in a healthy position to borrow more from the bank. So looking down at the next part is one reason for the trend in return on average equity percentage between 2022 and 2023. So the return on average equity percentage pretty much looks at the profit that the owner is getting back from the equity they've invested into the business. So a return on average equity ratio of 44.6% means that for every $1 that Mika's invested into the business, she's achieved a return of 44.6 cents in 2022, 52.4 cents in 2023, which is a very high returns. So in terms of saying that out, we'll just explain it first. So the return on average owner's equity has increased from 44.6% in 2022 to 52.4% in 2023. A large increase from an already high return on average owner's equity. And already high, guys, because 44.6% is already a very high return on equity compared to maybe a term deposit we'd get 4% or annually in a share market, you maybe index fund, you're looking at maybe 7 to 10%. 44.6, obviously more risk, but it is a very high percentage. So the main reason for this is probably the increase in sales, the increase in profit from 2022 to 2023. And the reason for the increase in profit was her introduction of, well, there's a few different reasons, but one of the main ones is the introduction of the second-hand inventory. So large increase from the already high return on average owner's equity. The main reason for this increase in average owner's equity is the increase in profit from, and obviously guys, just always referencing back to the resource booklet when we can. So from, just get the resource booklet, from 28,000 2022 to 39,300 in 2023. And then that's a 40% increase, which is a very high year-over-year increase in profit, which is due to the introduction. Right guys, so yeah, the return on average owner's equity has increased from 44.6% in 2022 to 52.4% in 2023. A large increase from already high return on average owner's equity, right? And then just really stripping it back to look at why it's increased. So profits increased, which has caused it to increase, and then stripping it back to the very base level, which is why its profit increased. A few reasons, one of the main ones being the introduction of second-hand inventory. So that's really all they're looking for there, guys, for A of question 3. Reasonably straightforward merit question. We'll go on to B, which is a bit more in-depth. So Mika is excited about opening up the prospect of a new store in Auckland. So remember, guys, in the resource booklet, it says she wants to open up this new store in Auckland. She expects that this will cost approximately $40,000 to set up. She has $15,000 in personal savings, that is earning 4.2% per annum, which means per year, which she could use to put into the business. So Mika has two options to fund the expansion into Auckland. So option 1 would be to use her $15,000 savings and borrow $25,000 at 11.5% per annum. And option 2 would be to borrow the full $40,000 at 11.5% per annum as a bank loan. So how should Mika fund the expansion into Auckland? And your answer, recommend which of the two options above Mika should choose. Use at least one analysis measure and one other reason to justify your recommendation. Explain why your recommendation is better than the other option. So this is one of those NCA questions where there's no right answer. It's just if you can correctly justify your answer. In large though, it's probably a better idea for her to use 15,000, sorry. It's probably a better idea for her to use 15,000 of her savings and borrow 25,000 at 11.5% per annum. So the reason for this, guys, well, there's a few reasons, but the two main reasons that I want us to look at is first that currently her return on equity ratio is so high at 52.4% that she should definitely invest 15,000 of her own money, as the return on investment would be very, very high, much higher compared to the 4.2% per annum that she's earning at the moment in her personal savings account. And then there's a few other things we could talk about, maybe finance costs increasing more with the more debt, so because obviously there's more interest on loan. But what I was going to talk about for the second bullet point was looking at the equity ratio, which is in a much stronger position if she borrows less. So we'll get onto that here, guys. So just start a new line. Okay, so we'll just say Mika should invest 15,000 savings and borrow 25,000. Okay, so as profitability is high and is showing an upward trend, and as the current return on average equity ratio is 52.4%, Mika should invest her 15,000 into Mika's Music World. This return on average return on average equity. This return on average equity means that the money Mika means that the 15,000. Remember, we always want to reference to numbers when we can. Remember, the 15,000 Mika invests will generate a return of 52.4%. Okay, this is substantially, 100% sure how to spell that. This is substantially higher than the ROI, also the return on investment. That's what ROI means, the return on investment, ROI, that she is currently earning at her savings account. I think it's 4.2%, at 4.2%. Okay. Meaning investing the 15,000 would be much more profitable for Mika. Yeah, so that's all they're kind of looking for those first two bullet points. Sorry, for that first one of those reasons, one of the analysis measures. Our second one is also going to be an analysis measure. You could give a non-analysis measure, but yeah, it's not too important. So the second one we're going to look at is the equity ratio. So the second reason for this is the second reason for this being the better option is that if Mika invests 15,000, Mika's Music World, her business, will only need to borrow 25,000 as opposed to the full 40,000. Borrowing only. So here, guys, this is when it becomes useful to know how to do the equity ratios and calculate the formula. Obviously, they give you the formula in the test, but it is useful to have a little bit of experience doing it so you don't mess it up in the exam. Because here, what they're actually looking for you to do is to calculate the two different potential equity ratios that they would give you. If you're really looking for an E8 mark, you'd still get away with it if you're only getting an E7 if you didn't do that. But yeah, so if we just do that out, I've already got it written down, but so borrowing only 25,000. So borrowing only 25,000 would mean Mika's Music World's equity ratio would only be, I think it would be 0.6221, which is still within that kind of Goldilocks zone of 0.6 to 0.85, which is a much more financially secure position than if she were to invest, to take out a $40,000 loan, which would result in a equity ratio of 0.53 to 1, a much less financially secure position, right? It's getting very dangerously close to 0.5 to 1, and it's already kind of getting in an unhealthy position if it's below 0.6. By borrowing less, there is also less finance expenses, as there is less interest to pay on their loan, as the primary loan amount is smaller. Yeah. Also, which will help to provide a higher profit for Mika. So that's all they're kind of looking for. Sorry, the formatting is a bit, should probably try to fix that. But yeah, so she's going to get a very high rate of return with the money she invests. Well, by judging from this, and just for the purposes of keeping it simple for NCA, she probably would. Much higher, at least, than her 4.2% ROI at her savings account, meaning that she's going to make more money on her $15,000, and then borrowing $25,000 as opposed to $40,000 means that it would be a lot more financially secure and a much more healthy equity ratio. And then finally, there's going to be less interest on loan, which means finance costs will be smaller, which means profit will be greater, most likely, which means that Mika will make more money, which is ultimately the goal of her business. See, that's kind of wraps up question 3 and the 2 point sorry for keep bumping that, the 2023 exam. I'm going to go on to doing a few different videos in accounting now, so definitely stay tuned for those. Yeah, sorry for my voice being a bit croaky. I've got a cold at the moment. But perfect, guys. Yeah, have a great rest of your day.